All right. Today is Tuesday, February 22nd. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. The tape was really interesting, to say the least. And while we saw the Russia-Ukraine tensions escalate today in a big way, are we seeing a temporary climax in the conflict, at least for now, which will enable a relief rally in the stock market? This is the question that we're going to explore the answer to throughout this video. So let's not waste any more time, and here it is, in focus tonight. Let's talk about Russia-Ukraine once again, major updates, and then we'll talk about macro, including the data that we got from the UK today. And lastly, let's read the tape and see if we can find any moves to make in the stock market right now. Let's start with the Russia-Ukraine tensions, and of course, Vladimir Putin is playing chess, no doubt about it. Meanwhile, we're playing checkers. Because the talk so far has been Putin's going to invade Ukraine, it's going to be a major conflict, yada, yada, yada. But so far, what Putin did is a gray zone kind of move. In a speech yesterday, which was bizarre to say the least, and very long, pretty much a history lesson from Putin's perspective, of course. He announced the annexation, because that's what it really is, the annexation of certain territory within Ukraine that he believes belongs to Russia. But if you listen to the speech, once again, which was a really hard speech to listen to, by the way, in a nutshell, Putin pretty much went into the Israel-Palestine kind of territory, where God gave us the land. How do you start to even negotiate with somebody who thinks like that? And this is pretty much what Putin said. Ukraine belongs to Russia, and he's going to take back what belongs to Russia. So this is a major conflict right now, which will escalate once again. So the stock market is not out of the woods yet. But in the meantime, did we reach somewhat of a climax, at least for now, which will enable the stock market to move higher? When we talk about the climax, in response to Putin's announcement, of course, President Biden came out today and announced sanctions. And the sanctions were much milder than expectations. And therefore, you saw the Russian stock market surging after hours. Likewise, the Russian ETF, the RSX, closed well above the lows, took a major leg higher after Biden's announcement, and we saw the Russian ruble also moving a little higher. On the other hand, oil, gas, gold, palladium, the poster boys for this conflict, actually closed well below the highs. So again, did the market read the action today as perhaps we're reaching a climax for now? This is as bad as it's going to get, at least for now. We'll see. Because we have more escalation, more responses. Perhaps the most major response came from Germany, announcing that the Nord Stream pipeline 2 is pretty much not going to be certified for now. Now understand this. The flow of gas from Russia to Germany is still going on. We have Nord Stream 1, we have the Yamal pipeline, and many other pipelines that go through Belarus, but most importantly, Ukraine. Now, this map might be a little hard to read, but look at Ukraine. Look at how many pipelines go from Russia through Ukraine all the way toward the European Union, but specifically Germany. A lot of them. And Russia pays Ukraine pretty much $1 billion a year for these pipelines to flow through Ukraine. The importance of Nord Stream 2 is it bypasses all of these pipelines. It makes all of these pipelines obsolete, and hence, there is an economic aspect of this conflict. If this map wasn't clear, here's another one where you can see clearly that we have Nord Stream 1, which is still active, by the way, and then we have Nord Stream 2. This is what the German Chancellor announced today. They're not going to certify it for now. But again, there wasn't any flow of gas from Nord Stream 2 to begin with. So the pop that we got in the stock market right after the speech by President Biden is pretty much an indicator that perhaps the worst fears are behind us, at least for now. We're not seeing major sanctions. We're not seeing sanctioning of exports from Russia, because that would be crippling to the European economy and pretty much the US economy. The global economy as a whole will suffer if such a thing happens. Don't take my word for it. Today, Medvedev from Russia came out and said that the lack of certification from Nord Stream 2 pipeline could double the price of gas to the European Union, specifically Germany in this case. Now, he's playing tough right now. There wasn't flow to begin with to double the prices of gas. But perhaps what Medvedev is alluding to, that if more restrictions happen, the price of gas will certainly double for European consumers. Because if these sanctions really happen, as you can see from the map, a lot of European countries specifically toward the east, are heavily reliant on Russian imports, specifically oil and gas. So if everything stops as it is right now, with the sanctions that we hit Russia with right now, which are pretty mild to say the least, and the lack of certification of Nord Stream 2 by Germany, which wasn't active to begin with, if this is what the market is looking at right now, then the worst is behind us, and we will see a relief rally in the stock market. If there is escalation, and there will be escalation by the way, then the market will panic again. So it's going to be jittery, but we're looking for a relief rally. Now, the question you might ask is, why didn't Biden and the European Union impose perhaps harsher sanctions on Russia today? The answer is, we have an inflation problem, and imposing sanctions on Russian exports will amplify the inflation problem and perhaps cripple the European economy and perhaps the US economy. But we have the propaganda out there. Look no further than Professor Jason Furman, who said that inflation is a high-class problem. Well, he came out yesterday and said that Russia is unimportant to the world's economy.
What a stupid son of a bitch.
And it is pretty much a large gas station. That's all there is. This is, by the way, the same Jason Furman who said that inflation will be transitory, and he turned out to be wrong. This is, by the way, the Harvard Obama-appointed economist, and he got it wrong from the get-go, and he's absolutely clueless about what's going on right now. Meanwhile, the guy you're listening to right now, not a Harvard, not a Yale, matter of fact, public schools, barely finished college, from the street, yet I got it right from the get-go. Why do these top economists and propagandists get it wrong? It is exactly because they are propagandists. They're not really economists. We also heard from another antique today, Anthony Scambagamushi, who came out and said Ukraine gets him nothing, talking about Putin. It's a welfare state that will only add to the deficits. Sanctions will cripple him. He will be toppled from inside. Hold the line. Hey, Scambagamushi, what about this? Russian exports to the world. 18% of wheat exports, 17% of natural gas, 12% of crude oil, and 20% of global fertilizer exports. You really think if we sanction Russia big time and we see a disruption of supplies from Russia and Ukraine combined, we're not going to see a major inflation problem? Think again. We also have a lot of American companies with exposure to Russia. For example, Philip Morris, 8% of the revenues come from Russia. PepsiCo, 4.4%. Mohawk, 4.3%, McDonald's 4.2%, and the list goes on and on and on. There will be severe economic damage to this country, but most importantly, the European Union, if we see the harsh sanctions scenario. And by the way, it is inevitable right now because Russia is going to get into these territories. Then they're going to say, oh, certain Ukrainian troops had us back, and now we're going to start a war and march all the way to Kiev. So the movie's not over yet, but perhaps we have a settlement, at least for now. When we talk about Ukraine, look at the wheat production in Ukraine, one of the largest wheat producers in the world. When we look at the eastern regions, the regions that Putin is interested in, they happen to be the largest producers of wheat in the country of Ukraine. You really think that this has nothing to do with economics? Think again. Ukraine is really rich with resources, whether we're talking about palladium, gold, iron, nickel, zinc, copper, urea, potash, all the elements that go into fertilizers, for example. The country is extremely rich with resources, and of course, Putin is eyeing all of these resources to grab. What concerns us is the disruption of these supplies from these two countries, Russia and Ukraine. This will add fuel to the fire of inflation and push the Federal Reserve to become even more hawkish than we thought. And of course, the pumpers said Putin's not going to do anything, no sanctions, nothing is going to happen because he's got to worry about the oligarchs and the Russian stock market. Well, now you know that you're wrong. The bulls are absolutely desperate right now and comical. They're pathetic. Everything they said is wrong. So stop listening to the pumpers and listen to the market and what the tape and the psychology of the stock market is saying right now, which we try to read every single day in this program. Now, let's segue to macro, specifically inflation, because we're getting stunning data out of Europe, specifically Germany, and today the UK. You see, the German chancellor today was mild in sanctioning Russia, pretty much not certifying a pipeline that wasn't active to begin with. Meaning nothing. Why? Because I shared the data with you yesterday. Factory gate inflation in Germany has reached 25%. If we have disruption of gas flow from Russia to Germany, that economy will collapse instantly. So perhaps the German chancellor responded to certain American pressure that you got to do something here to show Putin that we are united And this is what the Chancellor chose to do. When we talk about the UK, again, stunning piece of data. UK manufacturing price pressures at the highest level since 1976. The Confederation of British Industry, CBI, said a net balance of 77% of manufacturers surveyed this month plan to raise prices, up from 66% in January, the highest reading since December 1976, a year of financial crisis in Britain. The survey also showed a net balance of 20% of factories reporting rising orders, down from 24% in January. Hello, stagflation. While this was the weakest reading for 4 months, it was still well above the survey's long-run average. But the trend is clear here. More manufacturers are raising prices while the orders are getting down, trending down. We're heading into stagflation. And this is the joke, by the way. Listen to this. The official annual rate of consumer price inflation rose to 5.5% in January, the highest since March 1992. Does anybody listening to this program from the UK believe this garbage right here, that inflation is at 5.5%? I'd say at least it is at 10%. The Bank of England this month predicted that inflation will peak at around 7.25% in April, when households' energy bills are due to rise by more than half. You cannot make this up. Look at UK housing prices, to the moon, making the great bubble of 2007-2009 look like a baby. This is absolute insanity in housing prices in the UK. We're seeing this in the US and pretty much globally. And look at this. This is a tweet from somebody called Simon London. And the picture is a bunch of tents, homeless folks, pretty much living in the streets of London. We're seeing these images not just in the UK. We're seeing it here across the US. Here in California, for example, we had a homelessness problem that goes way back, but it's getting absolutely insane out there. You're seeing more and more people living on the streets, tents all over the place. Thank you, of course, to the Federal Reserve and the cabal of central banks across the globe. They wanted to prop up the stock market higher, and this is the core and the root of this inflation problem. You gotta remember this, the root of all evil is the Federal Reserve. And it gets even worse in the UK. The UK's Farmers Union says food supply chains must share the pain of surging production costs, which would further raise grocery prices. And again, folks, this ties in with the Russia-Ukraine crisis. There is a limit where these European countries are going to absorb the pain. And Putin knows exactly that. He knows that the timing is right. He can take over Ukraine. What will the US and Europe do? Shoot themselves right in the foot over Ukraine? If we sanction Russia and those energy prices shoot up higher, we will see a crisis of the likes that we've never seen before, specifically in the United Kingdom, in Germany, and here in the United States. Consumer at the gas pump will be paying $7 to $8 in California. This will be a disaster for the Democrats in November. Now, let's get back to the USA. Today, we got US consumer confidence. It's not a surprise, it slipped down. Meanwhile, housing prices maintain the upward trend, meaning inflation in housing continues to move higher and higher and higher. The inflation crisis in this country is getting out of control. Many restaurants face extinction amid the thing, inflation, and staffing shortages. And this is heartbreaking. Inflation hits the poor, blue collar, and minorities the most. When we look at minority-owned businesses, when they're asked whether they are in fair or poor financial conditions, pretty much all ethnicities, the majority in all ethnicities, say that they are either in fair or poor condition. 55% of white businesses, 74% of Hispanic businesses, 76% of black businesses, 81% of Asian businesses. When these businesses are asked about difficulties hiring in the past year, 78% say too few applicants. There's a severe labor shortage out there. We cannot find workers. 56% say the applicant lacked the job-specific skills or education, along with the experience. 40% say it is competition from other employers. Now understand this. With the thing crisis, the number of graduates from colleges dropped down significantly. So we're seeing lower supply of workers to this market, to this economy. So this is going to continue to get worse and worse and worse, specifically for small businesses. On top of that, today we got the composite PMI for U.S. manufacturing and services. And as you can see, we're seeing a rebound higher in February's reading. What does that mean? Perhaps the drop was due to the Pokemon variant, but we're seeing a slight recovery and a bounce for now. specifically in services. And that goes hand in hand with what we discussed yesterday with Mohammed Al-Arian, who says that the economy, in the United States at least, continues to be resilient for now. And in my opinion, it is resilient for now because the consumer is swiping those credit cards up and down, up and down, up and down. And for now, their job security is intact. What will happen when the Fed start raising interest rates? We see stocks crashing. We see companies doing layoffs instead of hiring. What will happen then? This is a shaky recovery, a shaky economy with inflation surging higher while the pace of growth remains unsustainable. Hence the stagflation phenomenon. Let's go over the services PMI. Perhaps the majority of the good news is here. At 56.7 in February, up from 51.2 in January, the seasonally adjusted IHS Market Flash U.S. Services PMI Business Activity Index, how many words can you fit in a title, highlighted a substantial and accelerated upturn in output. This is the good news. Boosting the latest rise in business activity was a quicker increase in New York intakes. Companies noted the strongest expansion in sales since last July. International demand for U.S. services also strengthened in February. With demand conditions improving, service providers continued to hire extra staff. The increase was marked and the fastest in 9 months. This is the good news. Here comes the bad news. On the price front, there were sharper increases in both input costs and output prices. Notably, the rate of charge inflation hit a serious peak. What about manufacturing? The IHS Market Flash U.S. Manufacturing Purchasing Manager Index rose from 55.5 in January to 57.5 in February, signaling a stronger improvement in business conditions across the sector. Although the Supplies Delivery Times Index continued to inflate the PMI, the latest reading was also boosted by stronger increases in output and new orders. So far, so good. Production rose at a quicker rate in February, albeit one that was more moderate relative to those registered in 2021. Anecdotal evidence indicated that growth was hampered by raw materials scarcity, supply chain disruptions, and labor shortages. Factory orders increased at a sharp and accelerated pace in February, prompting firms to resume their hiring efforts after a blip in January. Export sales likewise expanded, with growth hitting a 5-month high. In contrast to the trend seen in the service sector, input cost inflation among manufacturers eased to a 9-month low midway through the quarter. That said, this is important, listen to this. The rate of inflation remained elevated and outpaced that seen for services. Additional cost burdens continued to be transferred to clients, as evidenced by another increase in factory gate charges. The rate of output price inflation was sharp and the fastest in 3 months. Finally, manufacturers continued to purchase additional input for use in the production process, with the rate of input buying growth improving to a 5-month high. Suppliers' delivery times, meanwhile, lengthened to the least extent since last May. So far, the picture is the economy is heating up once again, and inflation is moving higher once again. So we go back to the same dilemma. Good economic news equals bad news for the stock market because the Fed has no choice but to become more hawkish. And this is an excellent summary by Chris Williamson. And by the way, it explains why all of these states all of a sudden dropping the mask mandates and all of these draconian measures. Listen to this. The pace of economic growth accelerated sharply in February as virus containment measures tied to fight the thing wave were scaled back. Demand was reported to have revived and supply constraints, both in terms of component availability and staff shortages, moderated. With demand rebounding and firms seeing a relatively modest impact on order books from the thing wave, future output expectations improved to the highest for 15 months, and job growth accelerated to the highest since last May, adding to the upbeat picture. So far, so good. This is the shift from goods to services by the consumer. The problem is, how much more in reserves does the consumer have? Otherwise, the pop in services will not last for too long. The services sector rebounded especially impressively, accompanied by a more muted upturn in manufacturing. Goods producers remained hamstrung by supply shortages, which, although easing to the lowest since last May, continued to severely limit production growth, resulting in a further large rise in backlogs of work. Here comes the bad part. The supply constraints also contributed to a further marked increase in firms' costs, which rose yet again at another near-record pace in February. Increasing numbers of companies sought to pass these higher costs on to consumers. Resulting in the largest increase in average prices charged yet recorded by the survey. Once again, with growth rebounding sharply amid resurgent demand and price pressures rising again to all-time high, the survey will add to expectations of a more aggressive policy tightening by the FOMC. So again, what do you do with all of this? The economy is heating up again. It remains resilient. The consumer remains strong for now. We'll see how the consumer holds after interest rates go higher. But for now, you want to stick with companies with the pricing power. Companies that are passing the extra cost to the end consumer and their margins are still intact. And this is not what the Fed wants to see, by the way. Inflation expectations are surging out of whack, according to the Federal Reserve of Atlanta. And now Goldman Sachs is saying, yeah, the stimulus fueled inflation. It was due to the stimulus. But they stopped short of saying what the real reason is, which is, once again, the cocaine coming from the Federal Reserve. The stimulus didn't just drop from the air. It didn't just rain from the sky. The Fed enabled the stimulus. And of course, we're all watching the yield curve because it appears for now that the curve is about to invert. And this has been always a sign that in the next year, this economy will hit recession. Every single time, as you can see. Look at the line at 0. Every time we dip below 0, the following year or so, highlighted in yellow, the economy dipped into a recession. Now, let's read the tape for a little bit here before we move on. Let's talk stocks. Now, as you can see, I want to share this with you. This is, by the way, stunning. We have stocks that so far crashed more than in 2020 when the thing first arrived. For example, look at PayPal. From the highs, PayPal is down over 66.5%. Back in 2020, the big crash, PayPal went down by about 31%. How about RKKK for Tesla witch Cathie Wood? From the highs, that is down about 59%. Back in the 2020 crash, it went down 35%. Twitter is down 57.5% from the highs. Back in 2020, it was down 43.7%. You go down the list and we have Tesla and the Nasdaq. The drops so far from the highs for both Tesla and the Nasdaq are still below the 2020 crash. But if the trend is right, sooner or later, Tesla and the Nasdaq will also fall apart. This is in the long run, of course. What about the short run? Can we buy the dip for now, at least for a relief rally? Perhaps. This is what I'm anticipating for now, at least, because every time we heard about the Russia-Ukraine tensions escalating, oil, gold, palladium, wheat went higher, significantly higher. Today, oil, gold, palladium closed off the highs. Wheat futures closed a little earlier, so we didn't see a dip in that. But on the other hand, stocks moved off the lows. This is the indicator that we're about to initiate a relief rally. Now, the relief rally, I say it's a risky business because the relief rally could be interrupted once again by more escalation in the Russia-Ukraine front. But why do I say that the market is primed for a relief rally? Look at this, for example, the short bets against the SPY. We are now reaching pretty much the same levels of the 2020 crash, which is usually an indicator that we will see a dip, we will see a rebound. Who knows? We could see higher readings, we could see more shorting to come, but this is an indicator that we're getting way too bearish right away, and we are due for a relief rally. Likewise, when you look at the put open interest in the junk bonds, that surged out of whack, and it is for a reason. They're not wrong. But when you see extreme bearishness right away so fast, it is usually an indicator, a contrarian indicator, that the market could rebound higher for a little while. Here's the risk, though, when we talk about risky business. The VIX curve is about to invert, and every time the VIX curve inverted, it was because of a crash in the stock market, a major crash, a historic crash. It looks for now that we're heading that way. Usually, these kind of shocks are an opportunity to buy. So we might see Russian troops, for example, marching toward Kiev, and we see a massive escalation in the war. You bet the VIX will explode higher, and we will see the market crashing 10-20%. In normal times, we would say that that is a buying opportunity. The problem is, the main concern for this market is not Russia-Ukraine. The market could care less about Russia-Ukraine. The market only cares about the conflict because of inflation and the Fed's policy. And for now, when you combine the Fed's policy and the conflict, you have a double whammy against the stock market. So if I'm reading the tape right, we will have a short-term relief rally, perhaps, if things don't escalate in the next few days. But sooner or later, it is inevitable. We will see massive escalation, and this will produce a crash in the stock market of 10, 15, 20%, and the VIX will surge significantly higher. We will see the inversion of the VIX curve. Now, how do you play the upcoming relief rally if it happens, you might ask? And again, this is risky business. This is not financial advice. I could eat a pie in the face right away tomorrow, right off the gate. But this is what I did. I tweeted this. I said some oversold stocks like Facebook and PayPal are tempting to trade, but that requires brass balls. And guess what? I got some of those. So what I did today is the following. Number one, I shorted the name that was popping higher on the Russia-Ukraine tensions. This name is the ticker PM Philip Morris. As you can see from the weekly chart, we're getting way overextended. It doesn't mean that the stock has to fall right away, but the risk versus reward says we are due for a pullback. On the other hand, I bought some call options for PayPal, the ticker PYPL. Here's a weekly chart. PayPal, in its history, never been this oversold on the RSI. Never. This is a severe crash, erasing all the pandemic gains, so I'm bidding for a rebound here. I'm not saying PayPal is a grab right now to buy the stock and add it to your portfolio. I'm just saying we could see a relief rally, and buying call options, playing the relief rally, could produce some profits. But this is high risk territory. I cannot guarantee that this will work. For all you know, I could wake up in the morning tomorrow with a nice warm piece of pie right in the face. So proceed with caution. Anyhow, folks, we're gonna move on here and cover the market information for you, but relax. Rest assured, I have more charts for you and more moves that I did today. But before we do that, let's see how the indices closed today, and here we go. The Dow Industrial Average was down 482.57 points, or a decline of 1.42%. The Nasdaq down 166.58 points, or a decline of 1.23%. The S&P 500 also down by 44.11 points, or a decline of almost 1%. What about the sector's performance today? Shame on all of them. Every single sector is down today, and the declines were led by cyclicals, technology, and industrials. What about the advance to decline ratios? NYSE 21% advancing versus 76% declining. The Nasdaq 24% advancing versus 73% declining. And by now, watching this channel for a while, you might be aware that every time we see these exaggerated ratios to the downside, we see a pop higher, at least in the futures overnight. Moving on to commodities. Energy futures were trading a lot higher today, but regardless, they managed to close in the green, be it way off the highs. The WTI closed with gains of a little over 1.25%. Brent closed shy of 1%, but you might have noticed this. Crude oil Brent was almost at $100 a barrel at the highs of the day. Likewise, we have gains for gasoline, heating oil, natural gas, once again, be it way below the highs. Could be a signal that equities are about to rally starting tomorrow. If this holds, of course. If we see a dip in energy prices. What about softs? We have a down day for lumber and cotton, while we have gains led by sugar, OJ, cocoa, and coffee. We'll talk about coffee futures in a minute when we cover commodities news. What about metals? Look at gold. Gold was blasting higher, closed pretty much at the flat line. Another signal that perhaps the Russia-Ukraine tensions, at least from the market's perspective, are easing a bit. We have some modest gains for silver and platinum. Palladium also gained slightly. It was a lot higher at the highs of the day, but by now you know the story. Palladium closed well below the highs. On the other hand, we have a loser here, not by a lot. Copper, pretty much in the flat line with modest losses. What about meats? Muted activities for live cattle futures. On the other hand, feeder cattle futures down almost 1%. And look at this, the new big tech. Lean hogs surging higher with no stop in sight. Although, if the actual big tech starts to rally tomorrow, we might see the rotation from the new big tech lean hogs to the actual big tech. In the meantime, what about grains? Massive gains in grains. Most notably, wheat futures closed with gains of over 5%. 4.5%. Do yourself a favor here and pull up a chart of wheat, and you'll understand that we haven't seen the highs yet. We might see a dip tomorrow, but we haven't seen the highs in wheat futures, and if the tensions escalate once again, buying the dip in wheat is a good move. Today, we also have gains across the board in grains, be it soybeans, soybean meal, soybean oil, corn, rough rice, canola, all in the green massively, with the loser being oats, losing a little over half a percentage point. Let's talk about commodities news, and we start with coffee. The headline reads, fund managers have never been this bullish on Arabica coffee. Money managers increased their net bullish wagers on Arabica coffee to the highest in records going back to 2006. Government data as of February 15th showed Friday. Why are they this bullish, you might ask? Here's the answer. A global supply crunch caused by plunging output in top grower Brazil, plus soaring input and transportation costs, have pushed the beans favored by Starbucks to repeated decade highs recently. Lingering uncertainty about production this year is waiting on traders ahead of the winter season in the southern hemisphere, with unfavorable weather could extend the shortages into the third year. So the tailwinds for coffee remain intact. What about corn? Here's the problem with this inflation. Food inflation is worrisome. We might see a famine, folks. I'm not joking. The headline reads, poor rainfall in Kenya is among the main reasons why production of corn, the country's largest staple food, is expected to be as much as 20% below the 5-year average. So what are they going to eat over at Kenya? What about poorer countries than Kenya, with surging food inflation, grains inflation, and these weather phenomenons? Oh boy. And this is what Jerome Powell doesn't understand. His actions could cause a global famine. What about soybeans? Perhaps we can find some relief here. The headline reads, world soybean appetite is set to shrink for the first time in a decade. Now you might say, okay, so the demand for soybeans is going down. Prices of soybeans will also go down. Wrong. Here's why. Soybean consumption will edge 1.1 lower in the current season, the first drop in a decade. The London-based International Grains Council forecast Thursday. Drought has crippled soybean heavyweights in South America, shrinking crop prospects and propelling prices 19% higher this year. That is curbing reserves and will herald some demand rationing, the IGC said. So again, the demand for soybeans is not going down. The consumption is going down due to the lack of supply. Matter of fact, India just made its biggest purchase of soybean oil from the United States ever. There's a cooking oil crisis in India. Prices are surging out of whack, and you know that the cheapest oil out there, at least was, palm oil. Palm oil is destructive to the forest in Indonesia, Malaysia, all these countries, and it is destructive to the wildlife. So continuing demand for palm oil by India is extremely concerning. But perhaps we have some good news. It's actually good and bad news. Good for the environment, bad for India, and it ties up with Russia-Ukraine once again. India made its biggest soy oil purchase from the US because there is no supply from South America, mainly Brazil and Argentina. Indian traders have contracted to import a record 100,000 tons of soy oil from the United States because of limited supplies from drought-hit South America, at a time when prices of rival palm oil are scaling record highs. So India decided to go with soy oil because palm oil is getting so expensive. Once again, good for the environment, not so good for inflation. Because the higher purchases from the United States are expected to support U.S. soy oil prices, which have climbed nearly 20% this year to close their highest in a decade, fueling worries about food inflation. How does this ties up with Russia-Ukraine? Here it is. It is due to sunflower oil. Ukraine happens to be the largest producer of sunflower oil. So moron Jason Furman and scumbag Amushi better listen to this. Crude oil or palm oil, CPO, is being offered at about $1,575 a ton, including cost, insurance, and freight. And this is for the Indian consumer. And it compares to $1,620 for crude soybeans and $1,515 for crude sunflower oil. So obviously the cheapest one out there is sunflower oil. Sunflower oil is the key to save the forest. If we have more production of sunflower oil and that gets cheaper, India will import more sunflower than palm oil. What do you think will happen if Russia invades Ukraine and we have a supply constraint for sunflower oil? Well, these prices are going to surge higher. Soy oil was cheaper than palm and sunflower oil last month, but the sudden jump in soy oil demand has lifted prices by 16% in a month, the highest in 14 years. And here it is. Sunflower oil is cheaper than palm and soy oil, but some buyers are skeptical about deliveries because of geopolitical tensions. This is regarding to the Russia-Ukraine tensions. So India decided to go with soy oil. And here's my unfortunate prediction. Now that sunflower oil is a no-go due to the Russia-Ukraine tensions, and now that soybean oil prices surged higher again, that leaves the alternative as palm oil. So in the next batch, India will have to buy more palm oil once again. And that explains why they took advantage of lower prices for soy oil, and they made the largest purchase ever. More soy news for you. ADM, this is Archer Daniels, one of my favorite companies, sets record for single soybean shipment from northern Brazil. Everybody's taking advantage of the dip in soybean prices. Now, ADM happens to be a heavily integrated company. They ship, they buy, they process, and produce. U.S. grains merchant Archer Daniels Midland said on Tuesday it has carried out the largest soybean shipment in the history of the Ponta de Mantarara, located in the northern Brazilian city of Barcarena, as it shipped 84,802 tons in a single vessel. This is what I call buying the dip like crazy. Here's the problem for a company like ADM, which, by the way, I've been recommending for you in this channel since last year. And I told you about the resistance at 52.22. The moment that is broken to the upside, you buy the stock. And since then, the stock surged higher by almost 50%. But even these inflation hedge stocks will suffer because at some point, they're paying more and more and more for soybeans. If they cannot pass the extra cost to the consumer, their margins are going to continue to shrink and shrink and shrink. At some point, folks, inflation is going to destroy everything, and hence the Fed has to move off the rest. Moving on to options, the big casino. What's going on here? The volume is down, perhaps a bad sign for the bulls, but maybe if the market opens higher tomorrow, we could see more buying of call options. For now, Apple remains at number one, coming up with 950,000 contracts traded today. About 59% of those were calls. At number two, Tesla, the souffle, with about 650,000 contracts traded today. About 50% of those were calls. At number three, AMD, with almost 500,000 contracts traded today, about 66.5% of those were calls. What about the unusual activities that took place in the options market today? We have a lot of those, starting with the ticker XLY. This is the ETF for consumer non-discretionary. Somebody's buying puts here, big time. They bought the 140 puts for the expiration date, April 14th. With the expectations that the name could drop down by more than 20% by then. Watch out, the spread is wide here. But they paid about $3 a piece to enter this trade, all in all spending about $9 million. What about the ticker ARKF? This is for Tesla witch Cathie Wood. She's been beaten down severely. They've been tag teaming Cathie Wood over and over and over again. Maybe it's about time to give her some relief before she gets beaten again. Anyways, somebody bought the 26 puts for RAKF with the expiration date of March 18th with the expectations the name could drop down by more than 7% by then. They paid about $1.15 a piece to enter this trade. All in all, spending about $1.7 million. What about the ticker LVS for Las Vegas Sands? Somebody's buying more calls. The name has been surging higher, and they're expecting more gains to come. So they bought the 48 calls for the expiration date, April 14th, with expectations that the name could pop higher by more than 5.5% by then. They paid about $2.25 a piece to enter this trade, all in all spending about $2.8 million. What about the ticker ADI for analog devices? They're buying puts, the 150 puts for the expiration date, April 14th, with expectations that the name could drop down by more than 7% by then. They paid about $5 a piece to enter this trade, all in all spending about $5.5 million. What about the ticker LY for Li Auto? They're buying puts here, the 26 puts for the expiration date, February 25th, meaning this Friday, with the expectations that Li Auto could drop down by more than 6% by then. They paid about 60 cents a piece to enter this trade, all in all spending about $500,000. Continuing with interesting trades, what about the ticker BABA Alibaba? They're buying calls here, the dip, 120 calls for the expiration date February 25th, with expectations that Baba could rebound by more than 6% by then. They paid about $2.20 apiece to enter this trade, all in all spending about $1.8 million. What about the ticker DT Dynatrace? The name is well below the highs, and somebody's buying the dip here, expecting a rebound higher. They bought the 45 calls for the expiration date May 20th, with expectations the name could pop higher by more than 10% by then. They paid about $3.30 apiece to enter this trade, all in all paying about $2 million. What about the trades for the ticker AMZ and Amazon? Now, there are many ways to read this trade. You can interpret it as a strangle trade as I'm reading it right now. Or it could be somebody selling puts to finance calls, or selling calls, a holder of Amazon selling calls to buy some puts. Either way, if I read it as a strangle trade, somebody's betting that Amazon has a big move to come, but they're not sure which way. So they're buying calls and puts. They bought the 2,800 puts and they bought the 3,200 calls, all for the expiration date February 25th, meaning this upcoming Friday. They paid about $5.50 apiece for the 2,800 puts, and they paid about $2.20 apiece for buying the 3,200 calls. All in all, they spent about $7.70 apiece to enter this trade, and that brought the total all the way to about $4.5 million. Lastly, what about the ticker TDOC Teladoc? They're buying the dip here via calls, at least in the short run. They bought the $70 calls for the expiration date, February 25th, meaning this Friday, with expectations that the name could pop higher by more than 7% by then. They paid about $3.70 apiece to enter this trade, all in all spending about $2 million. Moving on to the heat map analysis, what's going on here? A sea of red, bloodbath, matter of fact throwing the baby out with the bathwater. It is the kind of day that indicates that perhaps we're getting, at least for a short-term bottom, because they're throwing out even the good names. Now, the notable movers, how about Home Depot? What a disaster that one was. Down almost 9% for the day. Why? Home Depot reported excellent earnings, by the way. They beat in the top and bottom line. They increased dividends by 15%. They're beating inflation. But of course, investors are looking forward and they're seeing that perhaps that earnings from Home Depot are peaking and they're going to lose to inflation in the next quarters to come. Specifically, if we have higher interest rates and a slowing down in the housing market. What about McDonald's? Look at McDonald's lighting up green. This could be a safe place to park some cash right now. There is no guarantee that it's going to buck the trend and move higher when the market crashes, but it could outperform the market in the months to come. More notable movers, what about LCID Lucid down big today, over 4%. On the other hand, pretty much every auto manufacturer was down today. But we have bad news for Lucid. They are recalling 200 cars. Is that all of them? Due to some collision risk. These smart cars, turns out they're not really that smart. What about the ticker M for Macy's? It was up big in the morning. On the heels of earnings, they beat on earnings, top line, bottom line. They're increasing dividends. Macy's is increasing dividends. How about you avoid bankruptcy first, right? On top of that, they're announcing a $2 billion share buyback purchasing program. What? I say short the name, at least I did short it today. When you look at the weekly chart, are we seeing a bear flag formation? The name closed well below the highs today, and I see a lot of trouble for this name. Now, it is too early to short, I'll give you that, but again, I shorted Peloton, Zoom, DocuSign, Mama Cathy Wood, RKK, Moderna, and everybody told me that you're crazy, bro. You're gonna lose everything. The shorties will die. Turns out these were some of my best trades ever. So I'm shorting via put options right now, and if the stock drops down, I might short for real. Back to the heat map. What about Apple? We have some news for Apple here, the iMob. Apparently, the Apple Store employees are trying to unionize, and they're using Android phones to avoid the iMob from cracking down on them. What, are you not going to kick upstairs to the boss? We'll find you, we'll crack your kneecaps, we'll ban you from the store. Why? Because the capo di capi, Tim Cook, well, he got a 500% pay raise last year, and now he's asking for a $99 million package in compensation, on top of the dumping that he's about to do with his stock. Lastly, notable movers, what about the ticker DWAC, Dwack the Quack? This is the Trump scam, SPAC. You're not going to see it on the map, but it topped the charts on the App Store. Speaking of the iMob, so the stock was higher today. I might open an account over there, but I don't want to get bombarded by My Pillow ads. Anyways, let's move on to charts. We start with the 30 minutes chart for the SPY, the S&P 500. The chart has breached the line in the sand at 430, which has psychological importance. The chart is weak, and sooner or later, we're going to see another massive leg down. That doesn't mean that this zone is not supportive for now for a bounce. The chart could bounce higher to retest the resistance at around 434, even 438. But sooner or later, after the relief rally is over, if it happens to begin with, this chart will go down, it will breach the line in the sand again, and eventually it will breach even below 422 and create another massive leg down. We haven't seen the end of this story yet because the concerns are not just Russia-Ukraine, but mainly the hawkish Fed and inflation. Moving on to the daily chart for the continuous contract for the S&P 500. We closed pretty much in no man's land. You look at the candle, it went higher. It retested the highs of last Friday's candle and it failed to crack above it. It retested 4,384.5 and it failed to close above that number. It went down all the way to retest some support from which the chart bounced before. It did not go all the way to my number at 4,232, but it went down to previous support and it bounced from there, closing pretty much in mid-ground. So the action from a candlestick pattern perspective is inconclusive, but perhaps it is slightly good for the bulls. It provides some hope for the bulls that the support of 4,232 was not breached, at least for now. When we look at the volume, it spiked higher on a down day. Can you say that? Or was it a mid-ground day? So again, the volume slightly favoring the bears because it was a down day all in all, but we did not close at the lows of the day. So the bulls have hope from the candle. The bears have hope from the volume. What about the momentum indicators? Well, they're curling down in negative divergence, not by a lot. Another pop could fix all of that. So for now, the bears are holding at slight advantage. The bulls are fighting back. And the bulls, of course, are hoping for the double bottom scenario, where we could go a little lower, but so long as the support of 4,232 is intact, the chart could pop higher from the double bottom and it could recapture 4,384.5 and perhaps rally all the way to 4,472. This is what the bulls are hoping for. The bears say not so fast. We have too many concerns. Things could develop rapidly. Look at the VIX. We could breach below 4,232. You see, the bears are arguing from the fundamentals perspective, which tends to matter in the longer run. The bulls are arguing from the technical perspective, which tends to favor them in the short run. What about the Qs? 30 minutes chart. Again, it went down all the way to retest the support at around 334, but we are below the line in the sand at around 343, which remains as resistance. For now, let's say that we have a bounce tomorrow. The chart could recapture 343. They could eye 352 as resistance next. But if that happens to begin with, we're going to trade it. We're not going to buy it because sooner or later, this chart is going to flush down again. Because from a behavioral chart perspective, this line in the sand at around 343 has been retested over and over and over again, and it produced a significant bounce. Why would you go down there and breach below the line? The answer is because the chart is eyeing a lower level of support. That doesn't mean that it cannot bounce higher in the short run. What about the daily chart for the continuous contract for the Nasdaq? Again, highly volatile. It went higher to retest the highs of Friday's candle, and it failed to do so. The chart also failed to recapture 14,000 as support. This is the bearish perspective. But the bulls have a point too, because the candle went down all the way to around 13,600 and it bounced from that point beautifully. The challenge for the bulls though, can you recapture 14,000 in the overnight session? Because if you do that, then the build up on the gains tomorrow in the regular session will be easier. So for now, both the bulls and the bears have points to fight on when we look at the chart pattern. What about the volume? The volume spiked higher on a down day all in all, so that favors the bears slightly. The bulls could counter and say, but a lot of the volume also came in buying the dip after the Biden conference or speech, whatever it was. But the momentum indicators for now favor the bears. They're curling down. They are in slight negative divergence. That could be corrected right away with a pop higher tomorrow, but for now, the bears have a slight advantage because the bulls are fighting back. What about the IWM, the Russell 2000 30 minutes chart? It flushed down all the way to the support of 196.5 and it bounced higher before going back to retest 196.5. The question is, we ran out of time, so we don't have a conclusive conclusion yet. Will this retest be successful at around 196.5? And if it is, and the chart bounces higher again, are we looking at a descending line, sloping line of resistance that is about to be broken to the upside? This will be good news for the IWM bulls. It could take us all the way higher to 204.5 and then we'll fade the rip from there, depending on the news, of course. What about the Dixie, the dollar index? It remains in a bear flag pattern, hugging 96 as support, but it could flush down soon depending on the Russian ruble. If the tensions cool down for now, we will see a recovery in the ruble and the dollar will flush down, losing the support of 96. Let's look at the weekly chart for the Russian ruble. It caught support over and over and over again from this level. Today, it bounced higher again from the same level. Is this a signal that the ruble is bottoming right now? Could be. If it is, then the dollar is going down. And this could be good news for gold, but remember this, gold did not give a rat's ass about the dollar since the beginning of the year. Gold has been rallying on the tailwind of the tensions between Russia and Ukraine. If things are about to cool down, then gold will also cool down. It is now in quote-unquote overbought territory. By the way, I'm seeing a lot of bullish activities. All of a sudden, the Johnny-come-latelys, they're buying call options in the GDX, the GLD. Perhaps you're too late. When I see a lot of stampeding in buying gold all of a sudden, or any asset, perhaps it serves as a contrarian indicator that gold could pull back and then rebound higher again. What about the 10-year yield? Look at the resiliency of the 10-year yield. It recaptured 1.94 once again. What does that mean? For now, this chart has been moving higher on the tailwind of the hawkish Fed. It went down on the headwind of the Russia-Ukraine tensions. If it is moving higher again, isn't this a message from the market that says that the Russia-Ukraine tensions are peaking, at least for now? And perhaps we will go back to debating the Fed hawkishness. This will be good for the 10-year yield to move higher. The Fed's hawkishness is not that good for equities either, but for now, with the Russia-Ukraine tensions cooling, at least for now, while they remain on the table, you will see a lot of talk that perhaps the 50 basis points hike is a little too much right off the gate. And this could give the bulls the excuse to rally equities perhaps hand in hand with a rally in the 10-year yield. What about the TLT weekly chart? Looks beautiful for now, perhaps running a retest at 140 for resistance, but if the 10-year is about to move higher, then the TLT is going to flush down, so the battle continues. Now, there is tailwind for the TLT bugs, and this tailwind comes from Japan. As you can see, the purchases of bonds from the Bank of Japan went significantly down in 2021. The question is, with yields moving higher, the Japanese are looking for yields. Perhaps this will be a tailwind. The Bank of Japan will revamp bond purchases again. We'll see. What about the VIX 4 hours chart? See, this is the chart that favors the bulls right now. Look at the MACD indicator. It is curling down. It was a volatile day. The tensions ramped up higher. We have more sanctions. Yet the VIX did not move higher and crack above 33. Matter of fact, it closed at the lows of the day. Could this be a signal, a leading indicator that the VIX is about to cool down, at least for now, in a double top pattern at around 32, and then we will see the SPY climbing higher in a relief rally? I'm just reading the tea leaves for you. We will look at the 4 hours chart for the VIX after removing all of these markings in a line chart. What we're seeing is a triangle pattern of consolidation that will perhaps be broken to the downside. Then the VIX could catch support at around 24, that is support number 1, and then the ultimate support at around 20. And then rebound higher again. What about the VXN, the VIX for the NASDAQ? Similar story here. The MACD is still lighting up green. It is moving higher. It favors the bulls, but you gotta read ahead of time. Is what we're seeing right now a formation of a bear flag all in all that will take us down to perhaps retest the support at around 27.5? That could be the case. If that happens, we will see a relief rally in the NASDAQ, specifically in the oversold names. What about Apple? It is back within the channel. Bad news for Apple. This remains the concerning element in whatever relief rally that's about to come in the NASDAQ, because as Apple goes, so will the market. We're seeing the volume moving higher on a down day for Apple. The momentum indicators all curling down in negative divergence territory. That doesn't mean that Apple cannot pop higher and recaptures the upper range of the channel as support once again, perhaps run a retest at around 172.4 and then failing from there. What about Tesla, the souffle 1-hour chart? I closed my puts today because we got a little oversold. Perhaps Tesla will catch a rebound rally from a double bottom formation. It could run all the way to retest the trend line as resistance this time around, then fail from there. Once again, I'm just reading the tea leaves for you. I could be wrong for all you know. What about Bitcoin? Tulips. Once again, we have the double top. We went down all the way, not quite 35,750 baht. We saw the volume moving higher on a buying day today. This is good news for tulip bulls. Perhaps it is a sign that the Russia-Ukraine tensions are cooling off, and we will see a relief rally that includes Bitcoin. If the support of 35,750 is breached, then run for the hills. The momentum indicators are also curling their way higher. Look at the RSI. All of these are good indicators for the bulls. What about AMC? What's going on here? A bad day for the apes, but the hope is not over yet. If you go down to 15, 14, then the hope is over. But for now, perhaps the chart is getting a little oversold. Look at the RSI. And we will see another pop higher in AMC to run a retest at 21 as resistance. The hope is still alive for now. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the initial jobless claims. We also have the GDP revision. And lastly, new home sales. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.